1. The core link between trading frequency and net returns. Gross return versus net return. Research shows that investors who trade frequently do not earn significantly different gross returns compared to those who trade less. However, their net returns decline noticeably over time. The main reasons are transaction costs, taxes, and market frictions. The well-known study by Brad Barber and Terence O'Dean found that investors who traded less earned approximately 7 percentage points higher annual net returns than those who traded heavily. Conclusion: high trading frequency usually does not increase returns. Due to costs, it often reduces portfolio performance. 2. The compounding effects of transaction costs. Commissions, spreads, and slippage. Every trade creates both direct and indirect costs. Commission fees. Bid-ask spreads. Slippage, when an order is executed at a worse price than expected. Even if these costs seem small, when trading frequently they compound over time and gradually erode portfolio performance. Tax costs. Short-term trading has another disadvantage. In many countries, short-term capital gains taxes are higher than long-term capital gains taxes. This tax difference further reduces net returns. Conclusion: trading less lowers total costs and allows investors to keep more of their money. 3. Behavioral finance, psychology and emotions. Overconfidence and emotional reactions. Frequent trading is often driven by overconfidence, overestimating one's actual skill, loss aversion, trend chasing, and FOMO, fear of missing out. These behaviors often lead to buying and selling at the wrong time and reacting emotionally to market fluctuations. Research shows that frequent traders often buy near market peaks, sell near market bottoms. These emotional mistakes reduce long-term returns. Conclusion: emotional decision-making and short-term reactionary trading decrease performance. Patience and lower trading frequency improve psychological balance. 4. The advantage of time in the market. Time in the market versus timing the market. Investors who trade less typically remain invested despite market volatility. The advantages of this approach include capturing the best market days and periods, maximizing the power of compounding, avoiding emotional reactions to short-term fluctuations. Studies show that the best performing days in the market are randomly distributed over long periods, and missing just a few of these days can dramatically reduce overall returns. Conclusion: trading less protects investors from missing the best days and strengthens long-term growth. 5. Research on women investors. Less trading, higher returns. Various studies have found that women investors generally trade less, focus more on the long term, and as a result achieve higher risk-adjusted returns. This finding further supports the scientific evidence behind low trading strategies. Final conclusion: trading less does not simply mean reducing the number of transactions. It means lower costs, fewer emotional decisions, greater compounding, more consistent performance. Research consistently shows that the majority of individual investors underperform due to excessive trading, while those who trade less tend to achieve higher net returns over time. Of assets may disappear entirely within 10 years or grow dramatically. Uncertainty is high. The real question should be, instead of asking, what will happen in 10 years? A better question is, can I protect and maintain my system for 10 years? Because history shows, markets fluctuate, crises happen, but production, innovation, and economic activity do not permanently stop. Realistic conclusion: in 10 years, a disciplined, long-term investor will most likely see growth. A frequent trader will likely underperform their potential. A panic seller will suffer the most damage. Uncertainty exists, but the probabilities favor the patient investor. Final thought: we cannot know exactly what investments will look like in 10 years, but we can predict this with reasonable confidence. The biggest difference will not be created by the market. It will be created by the investor's patience.